Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering 5 stocks with ex-dividends next week. Now this is a regular series on my channel. Every Wednesday I pick 5 random stocks that have ex-dividends next week. I give my opinion on whether they are overvalued, undervalued, based on their graph performance. We take a look at their 1 year, their dividend payout, their payout ratio, their dividend history, and kind of give a good size of information, whether it be good buying opportunity, where if you bought into the stock prior to the ex-dividend date, do you think that the company would go up in the following weeks in order to not only get that dividend, but also just kind of go in it for the long term. And as a dividend investor, I do focus a lot on dividend stocks, so this is always refreshing to kind of look up 5 new stocks that I may never have heard of. The only one on here that I know the ticker symbol is VLO, and I've always looked at VLO or Exxon. They were both 2 good companies in the oil industry. So let's go ahead and get into it. Of course, if you are brand new to my channel, I do make stock market, dividend, investment videos weekly, so do consider subscribing for future financial videos. I do plan on coming out every Monday with like a new style of learning video where I'm talking about, some specific thing. Wednesday is my ex-dividends, Friday or Saturday I'll do my recap, and then any of the news that goes on, or just kind of like periodically throughout my portfolio will kind of showcase that. I do have my end of the month stuff that goes on and weekly stuff, so that's all here and there, just pieces sporadically. So the 5 stocks we're going to be covering are right here: MCHP, VLO, MCO, DNB, and NEE. So let's go ahead and get into it. If you are brand new to my channel, I do make this style. Okay, so anyways, number 1 we have here is Microchip Technologies, ticker symbol MCHP. The company engages in the development of manufacture of semiconductor products for various embedded control applications. The company's chips are used in the automotive, computing, consumer, industrial, and many other markets. So very similar to QCOM or NVIDIA, semiconductors. And ex-dividend date is Monday, so 20 November. You must purchase the stock this Friday or prior, and then you would be eligible for that pay date being paid out on 5 December. Now I do have their information just kind of charted out here. I have their dividend in the blue, their stock prices in the orange. I have their dividend yield in the red, and their book value in the green. So here we can see that their dividend, they pay out 36 cents per share per quarter. Their current stock price is $91.04 when I recorded this, or when I pulled this information. Their price to book value is 6.0, and they currently have a dividend yield of 1.59. Now you can see here that their yield is on a downwards trend, while their stock price has been moving up very quickly here. You can see for a while they were trading down here in the $72 range just back in April, and they've shot up to $91 and probably going past that right now. So there's been probably a lot of news, probably with the iPhone X and semiconductors, is when you talk in and you talk to your phone, whether it's Siri or Hey Google, that's a semiconductor performing that specific function. So very good growth there, very good growth. So when charted above, it does show that the current stock has a higher price to yield, which would indicate that it is overvalued at this time. The stock is over in the industry price to earnings average. It is below 60% payout ratio, which is nice, and it's had dividend growth for 15 years, which I would consider recession proof. Its price to book value is 6.0, so you're paying a 600% premium, which is higher than the 300% premium where value investors would consider a value buy. Its PE right now is currently 36.35, so it's pretty high in comparison to say Apple or the S&P 500, which is, I believe it's right around 17 actually for Apple, and I'm not sure what the S&P 500 is. I think it's probably right around there too. It may actually be what is it, like 25.69, somewhere around there. The current industry price to earnings average is 29.69 for their specific sector, and their current dividend yield 1.59. Their annualized payout is $1.45 per share, so divide that by 4 and it's 36 cents per share per quarter. Its payout ratio is very low, so 28.3, and it's had dividend growth for 15 years. So if you actually purchase this stock back in the past when the yield was way back here about a year ago, back in December, the yield was up here in the 2.8 range, where you were buying the stock in the $65 range, and you could have made some really good capital gains as well as dividend payouts. So that would have been the opportune time. So right now, the stock does look a little bit overvalued, but it will definitely come back down at some point. And dividend-wise, it's had dividend growth for 15 years, and it has paid out dividends since they started paying dividends. So 15 years ago today, they started paying out dividends, and they never pulled back. They never cut their dividend. They've continued to pay it out through the recession. So 2002 was when they started paying out dividends. So good company, just semi-overvalued at this time, where I would wait for it to come back down. The next stock we're going to be taking a look at is VLO Energy. Now this is one very similar to Exxon. So VLO Energy operates as an independent petroleum refinery and marketing company. The company operates through three segments: refining, ethanol, and retail. The refining segment engages in refining, wholesale marketing, product supply, and distribution, and transportation services. So they're pretty widespread. They're similar to Exxon. They have different segments, so their only segment isn't only in gasoline. So if gas prices were to drop, they still have other segments that would bring them in revenue, which would increase their stock price, similar to Exxon. Whereas Chevron is not, they're not as split up and diversified. So their ex-dividend date is similar. It's 20 November, which is Monday. So again, you'd buy it Friday or prior. They would pay out on 12 December. So here we have the same information charted. Dividend, so 70 cents per share per quarter is how much VLO pays out. Their current stock price is $81.46. Their price to book value is only 1.75, so pretty nice price to book value. And their dividend yield is 3.31. So you can see here that the dividend yield was very high up until September timeframe, where it did a crossover. If I can just move my mouse out of the way, you can see right here, if you were to go up at this point right here, they actually did a crossover where the yield fell below the price and the price began to shoot up. And that was probably when they increased gas prices during Hurricane Harvey. They may have lost some of their refineries, so they increased their prices in order to, because the supply ran low. So they increased their prices, that increased their price to book value, and increased their stock price. So you can see here that their price to book value was down here in the 1.4 range for quite a while, even falling as low as 1.3. So their stock was down here in the $60 range. It's now $20 higher in the $81 range. And their optimal time to have bought would have been where their yield is around 4.15. In that area would have been the optimal time to purchase the stock. So when charted, it does show that the current stock is a higher price to yield, which would indicate that it is overvalued at this time. The stock is under in the price to earnings average. It is sitting below 60% payout ratio, and has had dividend growth for 6 years. Its price to book value is only 1.92, which is lower than the 3.0 where value investors would consider a value. So the stock is currently sitting at 17.66. The industry average is 30.43. The dividend yield right now is 3.44. So this one says 3.30. But what I just saw is they actually moved their dividend payout from 59 cents up to 70 cents. So this actually puts their current stock price at actual break even. So they don't have a higher price to yield. Their yield would be right here too. So this would actually be a very fair valued stock. For you're getting a price to book value of 1.75. You're getting an $81 stock where they're paying out around actually over 4% yield right now. So actually very good buy. Let's see here. Their payout ratio is under 60, better than Exxon, better than some of those other oil companies. This is definitely way below 60. It's not way below 60%. It's a 58% payout ratio, so very nice. They've had dividend increases for 6 years. They did cut it for 2 years. They cut their dividend by 66% for 2 years. And I believe this was back in 2008, 2009 when I was looking into it, but then they increased it back to where it was. They increased it by 66% back to where it previously was, and then continued paying out and continued growth from that point on. So this is actually a really great buy right now, in my opinion. Now, the third stock we're going to be taking a look at is ticker symbol MCO, and this is Moody's Corp. Now, Moody's Corp provides credit ratings and related research, data and analytical tools, quantitative credit risk measures, risk scoring software, credit portfolio management solutions, and fixed income pricing data and valuation models, principally in the United States and Europe. So their ex-dividend is again Monday, and you would have to own the stock on Friday or prior. Their pay date would be then 12 December. So here we have their dividend per share here in the blue, 38 cents per share per quarter. Their current stock price is $143. Their current yield is 1.05. And you'll notice here that their price to book value is not on the charts. Each of these rows right here indicates a specific number. This is 38 cents for their dividend. This is 143 for their stock price. This is 1.05 for their yield. And their price to book value would be in this quarter, in this column, but it cannot fit on this graph because it is so negative that it is not returning. The price to book value, I did right here. Where is it? Oh, I may not have captured the correct price to book. They're actually negative. So MCO, when charted, it does show that the current stock has a higher yield to price. That's incorrect, so I'll have to correct that very quickly. Hold on one second. Okay, welcome back. So we're talking about MCO, Moody's Corp. So when charted, it shows that the current stock has a higher price to yield, which would indicate that it is overvalued at this time. The stock is over in the industry price to earnings average, and it is under 60% payout ratio and has had dividend growth for the last 7 years. Their price to book value is not charted on this graph. So this is what I was showing off here on our fourth column. It's actually very negative below to the point where it's not able to be charted, and that is mainly because their price to book value is not applicable. Their net tangible assets is 2,545,000,000 in debt, in the negative. So if we went over to their balance sheet here on Google or on Yahoo Finance, they have lots of liabilities where their liabilities greatly outweigh their assets by almost double. Yeah, well, not double, I guess, say, a couple million more in debt, and this is reoccurring debt, so it's, quarter after quarter, year after year, they've been picking up more and more debt, which they're not paying off. Nothing's being paid off. Everything is increasing year after year. If we go over to their quarter, their net tangible assets has been going down. It's negative, so that is why they are not currently profitable, which would give their price to book value a negative score. So they have way too many liabilities to be a great investment, either in the short term or long term. Again, their dividend yield is 1.06. Their annualized payout is $1.52 per share, or divide that by 4 is 38 cents. Their payout ratio is only 25.6 because they probably can't afford to pay out any more. They're taking out debt in order to probably pay out their dividend. And they've had dividend growth for 7 years. Between 2007 to 2010, they halted their dividend, and then they continued to rise after 2010. So I'm not sure how this company will go going forward. I don't see this stock being anywhere valued where it's at. So I could see that anyone invested currently in MCO is probably going to be hit pretty hard really soon. Next stock is ticker symbol DNB. This is Dun and Bradstreet. So they provide, so DNB provides business information and tools in the United States and International. DNB was founded in 2000 and is based in Short Hills, New Jersey. So their ex-dividend date is on Tuesday and they would pay out on 8 December. So when charted here, we see that they pay out 50 cents per share per quarter. So if you had 10 shares, you would get paid $10 for the quarter or $40 in a year. Their stock price is $116. Their dividend yield is 1.71, and their price to book value is again in the negative. So I wanted to I grabbed a couple of these randomly, but these ones I wanted to showcase why that price to book value was in the negative. So DNB, when charted, it does show that the current stock price is average price to yield, which would indicate that it is I would say it's semi-valued at this time, just kind of based off the graph. But then as we kind of dive into it, it is under in the price to earnings average. As far as the industry goes, it is below 60% payout ratio and has had dividend growth for 10 years, but its price to book value is not applicable because their net tangible assets is sitting at negative and they have too many liabilities. So again, here over at Yahoo Finance, you take a look at their income statement, and they're only, they're in the all numbers are in thousands, so 1,000 million, so 97 million, and this is annually. If we go over to their balance sheet, take a look at their assets, take a look at their liabilities. Again, their liabilities are, they outweigh their assets, and then towards the net tangible assets, everything's in the negative again. So not a great company to own in the long term. And yeah, let's go ahead and continue to our last and final stock, and ticker symbol is NEE. This is NextEra Energy. NextEra Energy. So this company engages in the generation, transmission, distribution, and sale of electricity in Florida. It produces electricity from natural gas, wind, nuclear, oil, hydro, solar, and other resources. As of December 31st, 2009, the company served approximately 4.5 million residential, commercial, and industrial customers in the east and lower west coast of Florida. So their ex-dividend date is 22 November, which is Wednesday. They would pay you out on 15 December. And you can see here, they pay out 98 cents per share per quarter, and their price is $158. So you could probably buy 8 shares for $1,000. 8 shares would give you $8 back, around $8 in dividend payout, or $32 in that year. So it's not a bad investment. Price to book value is 2.8. They're actually pretty positive. And they are positive, but their book value, okay, anyways. Their dividend yield is currently 2.41. You can see that back here in the past, their price was sitting right around $113. They've had a very nice growth spurt in the last year, where they shot up from $113 to $158. So when charted, it does show that the current stock is a higher price to yield, which would indicate that the stock is overvalued at this time. The stock is over in the industry price earnings average. It is below 60% payout and has had dividend growth for 7 years. Their price to book value is 2.82, which is under the 3.0, where investors would consider a value. So here the stock itself is price earnings of 17.8 in the industry of 14.61. The dividend yield is 2.48, so this is correct. The annualized payout is $3.93 per share. Their payout ratio is good, it's under 60%, it's 58.4, and it's had dividend growth for 7 years. Since 2010, they did have 2 quarters where they did not pay any dividends in 2010, and then they also had 1 quarter in 2014 where they didn't pay a dividend, but that is why this has only had dividend growth for 7 years. If you miss 2 quarters in a row, it looks like the dividend growth gets kind of discontinued, and you have to, like, if it misses 1 time, then it doesn't count as like a miss or like a cut. It still counts as dividend growth if you only miss 1, but if you miss 2 in a row, then it kind of counts as a like a stop, and they'll only include your growth after that date. So those are the 5 ticker symbols, and again, they are MCHP, VLO, MCO, DNB, and NEE. So out of these 5 stocks here, which one would you pick and why? Go ahead and leave it in the comments below. If I were to pick one of the stocks that we covered today, I would definitely choose VLO. Just because the current stock and the yield and the price to book value and all the information that was sort of presented, it's only half of the industry. Their dividend, they did have a dividend cut, but that was due to financial, the crisis that took place, but they didn't re-increase it back to where it was and then had continued their growth beyond that. So pretty good stock. They are very diversified as far as different segments. So if I were to pick one stock out of the 5 stocks that we covered today, I would definitely do a deeper dive in the VLO, take a look at their 10Q, their 10K, and go on from there. So that is it for this video. I want to thank everyone for watching up until this point. If you did like the video, hit the like button below, and please remember to subscribe for future financial videos. If you have any questions or want to say hello, please leave a comment below. Thanks for tuning in, and I will see you next time.